So what lessons can we learn from a disaster like long-term capital management? Um, it's it's a lot of things that are somewhat related, so certainly we're going to see some overlap between these two. But risk versus uncertainty, we'll look at some quotes on that, but there is a difference in the way finance and economics talk about risk versus uncertainty. They are two different things. Are markets really random, or can they go in one direction for a long time? We talk about correlations, liquidity, leverage. Leverage and liquidity are somewhat closely related. We talked about liquidity versus theoretical prices when we talked about credit risk for bonds, and we talked about price discovery. Over relying on models, I used that famous saying, all models are wrong, but some are useful, and sometimes models are actually harmful. That's certainly something that Doug Hubbard talks a lot about. How predictable, kind of related to the random markets versus predictability of markets versus the human factor. What happens when everybody's scared to death going in the same direction? We haven't talked much about Dr. Lowe. I should probably bring Dr. Lowe into this class. His idea of the adaptive market hypothesis of how humans behave at the extremes of greed and fear, and that's certainly part of this human factor. Too much concentration in a few names. We talk about Russia and the issue there. Getting into unfamiliar and assuming that's going to work the exact same way, that when you ran your models for other assets, it'll work at the exact same thing in other areas. And then a little bit of federal government involvement. That's certainly a huge issue right now in the coronavirus, and also in 2008 with TARP and the bailing out of certain industries. So let's look at the first one. So investing in IBM versus rolling a pair of dice, there's a difference in the two. With a dice, there's risk. So what they mean by risk is you can apply statistics very confidently to them. You know what the probability of rolling rolling snake eyes is. You know what the probability of rolling a sum of 7 versus a sum of 12 versus a sum of 2. There's risk there. There is no uncertainty, but there is risk. For you know for certain what the chances are. So investing confronts us both with risk and uncertainty. There are statistics to bond markets and stock markets and all other types of financial transactions, but there's also uncertainty that things will behave differently than they have in the past. Long-term capital management focused on risk, but they put aside uncertainty by simply placing a number on everything and just saying things were impossible. You saw that with their value at risk and how far off it was. Their risk model said that was impossible, but they could have gone back in history and seen some places of dislocation that would have given them some insight. So are markets random? So key condition of rolling dice is that your second roll is not in any way correlated to your first roll. Now we know probably there's probably something going on and out in the trillionth condition, but as far as our recollection and our understanding of physics and randomness, the second roll of the dice should not be any way related to the first roll. I play some games on my iPhone where there's random rolls, but I know it's not random. I know there's, pure randomness is practically impossible to create, but we can get close enough to a true random event, but are markets really that random? Markets have memories. Again, I'm getting back to Andrew Lowe, and the more I'm thinking here, I really should bring Dr. Lowe into this. But I do encourage you to read Dr. Lowe's Adaptive Markets Hypothesis. It's a really good book. But he says markets actually are not random. They do not follow a random walk. They do have memories. Momentum does exist. Stocks do tend to go in one direction for a while. So are markets really this efficient machine that just spits out new prices, all random? So when all the models say the same thing, everybody's doing the same thing, won't that itself change the randomness of markets when we're all herding together? We talked about that on evaluate risk. Correlations tend to move to 1 in crisis. We've talked about that a few times. In times of trouble, markets become much more closely linked. And in fact, they either move to 1 or to -1. So treasuries moved. Treasuries were up when everything else was down. So Treasuries correlations moved to -1. Everything else that was a risk moved to 1, which is really important when you're talking about Russia versus Brazil. So, long-term capital management saying, well, Russia could be risky, but we also have money in Brazil, and those are uncorrelated markets. Well, they're uncorrelated unless the entire world suddenly hates risk, especially emerging market debt risk. People are worried about Russia. They're also going to be worried about every other emerging market. And so suddenly these unrelated assets suddenly become overwhelmed. Merton said, no, markets don't do that, but they absolutely do that. And we've seen it several times since this book was written, but even before, they had some history they could show that. And so here you bring in correlations with liquidity, and we have not talked about this in the class yet, but this is really, I think, important, is liquidity itself. I think I mentioned it with Doug Hubbard and the contagion, like things get related, and liquidity is one of those things that get them related. If everybody's doing less liquid securities and suddenly they all need to sell, everything that was unrelated suddenly becomes related. So assets, if its assets would be susceptible to falling in unison if a time came literally everyone wanted to sell at the same time. So the key of correlations. So let's talk about liquidity. So long-term thought they could get out of these large trades without moving markets. They assumed that other arbitrageurs would recognize the value they saw and there'd be buyers. There was no liquidity in the markets. And actually, it's surprising to me, as brilliant as these MIT graduates were, there's plenty of history. You don't have to go back to the Great Depression. There's plenty of history of what we call credit market crisis. When credit markets freeze up, they do it probably on average about every 5 to 6 years. I have to go back and look, but we certainly saw one in '94. We certainly saw one in 2000. Saw one in '98. Saw one in 2008. We're seeing one possibly now. We'll see. The government's certainly stepping in with a lot of cash. So you get a sense with long-term capital management that this was some freak thing that happened in '98, completely out of the blue, but I don't think that's the case. We need money the most likely sources are also likely to be needing money at the same time. Because why do you need money? Because your assets are down. You got to cover your margins. You got to cover your cash calls, and so does everybody else. And how are you going to do that without selling assets? And selling those assets, everybody else is selling them. There's no buyers because this is a fairly concentrated market in a few hedge funds. And so long-term was at the mercy of these traders, and that what they were trading was so arcane and so specialized. There were very few dealers they could really trade with. And too much leverage. You might look up the concept of a Minsky moment. I think I don't remember how to spell Minsky, but let's see if it comes up. Minsky moment. You can definitely go to Wikipedia. So I misspelled Minsky, M-I-N-S-K-Y moment. You can go into Wikipedia, and he talks about how credit crises happen. Sophisticated investors come in, they start buying an asset that's been selling off, its price starts recovering, and then other institutional investors come in, the price of the asset starts going up, people get more confident, retail investors come in, the price keeps going up, there's all this demand that comes in, and then people start borrowing money. They borrow money. We saw this in the real estate market in 2006 and 2007. People start borrowing a lot of money because the asset price is going up. So who cares? Hey, I'm borrowing at 6%, but the price is going up 7, 8%. So people keep borrowing and keep borrowing more, and prices keep going up because people are borrowing to buy. And then you get to a point where people start questioning, wow, our price is too high. A few people start selling, and prices don't necessarily drop, but they stop rising. And since people are paying such high amounts for their interest, they were relying on prices going up 7, 8% so they could pay their 6% debt. Now their prices are only going up 2 or 3%. Now they're forced to have to sell so they can pay off their debt and make their debt calls. And then you have this huge credit crisis, everybody's selling, they have all this debt, and you have this levered, just unleveraging, deleveraging overnight. That's what I recommend Lacey Hunt at Hoisington to read about that. He sees that with sovereign debt around the world, and certainly coronavirus is greatly increasing sovereign debt around the world. So you can be big and illiquid and be levered, but if you're highly levered and illiquid, and you're playing Russian roulette, because you have to be right about the market, not merely at the end, but every day until the end. Because when things starts unwinding, you can say I'm right. We just got to wait it out. You can't wait it out if you got to pay your debt holders. You got to pay interest. It's just not possible. So one bad day and you're done for with that kind of leverage. So how good is quantitative finance? It certainly has become a huge part. Artificial intelligence now is starting to get into this. We talked about, is volatility constant? Are correlations constant? Can we really rely on the inputs to these models? We like models. They're certainly useful in helping us try to understand the world. But markets are not nearly as predictable. We're seeing stuff this year with the coronavirus that are just, probably most of y'all or all of y'all have seen the jobless claims, and we're hitting numbers every week, 3-4 weeks in a row, of in the millions, 4, 5, 6 million, when the previous high was 700,000. And it's just, we've never seen numbers like this. You saw oil prices on the future side, because there's no place to store oil, and the oil prices are trading at negative $37. People are actually paying you to take the oil from them because they don't have any place to put it. Yeah, we're seeing stuff that no model would have predicted. So that's what we call fat tails, and there are plenty of examples historically. You can go back actually hundreds of years. Dr. Lowe, I'd mentioned him. He has a book on technical analysis, and he goes back hundreds of years to talk about how technical analysis, we have data from back in the Roman Empire where we can actually see how markets actually traded, how information was exchanged. It's pretty amazing stuff. So we have a lot of history on this kind of thing, and the one thing we know is that these things happen again. These fat tails, completely out of the blue, completely implausible, and yet they happen. So can a model anticipate something you've never done before? So the unfamiliar. You're buying Russian debt in 94, 95. Russia, I forget the exact year the Soviet Union crashed, but it wasn't that long, there wasn't that many years before. It was probably 4 or 5 years before. There really wasn't any history really on Russia. It was a new country. You could talk about Russia before the Soviet Union, but that was a completely different country with czars and everything else. I mean, it's a completely different country. And coming out of communism, a democracy that's fragile, a lot of debt, and their models are saying they can somehow predict this. Churchill said Russia is a riddle wrapped in a mystery inside an enigma. Now that was obviously when they were the Soviet Union, but still Russia is a very unusual country, a strange thing to be betting on based on models for U.S. bonds. So according to the models, what happened in August should not have happened. It should never happen once in the entire universe. They've forgotten that traders are not random molecules. People are moved by fear and greed. Against that's where Dr. Lowe comes in. How do you handle fear and greed in a way they create these fat tails? They've forgotten the human factor. And here you have the banks eager to loan to long-term capital management. Forget where this is on the list, so let me go back to the list so you can see where we're going. So we talk about risk versus uncertainty, randomness, correlations, liquidity, leverage, reliability models, predictability of models versus the human factor, and then concentration of exposure, too much exposure with one name. So I listed one of them twice, but too much concentration. The banks were loaning so much money to Merrill Lynch, thinking they were the largest lender. Banks like Merrill Lynch were loaning to long-term capital management, thinking surely we're their largest lender. We're real proud, we're their biggest one. And then when this crisis hit, they discovered they weren't the largest lender, that there was lenders even larger exposed. And people were just amazed how much debt long-term capital management has. Too much concentration. So the banks had trouble exiting. So getting into the unfamiliar, I mentioned that talking about the human factor as well, but getting out of the unfamiliar with Russia, but they're getting away from places they had expertise. They were definitely, look at Merriweather, he was definitely an expert on U.S. bonds. If they had stuck there, they wouldn't have made as much money because the trades were going away, the markets were getting more efficient. But they could have made some money. It would have, been much smaller than what they had in the past. So Scholes, he's the one that came in and said, hey, some of the stuff you are doing is just outside of your expertise. What are you doing? You don't have any information on advantage in Norway. So they became lax because they were getting rich. And remember, they thought, well, we're getting rich, so we must be smart. But it didn't quite work out. What about the federal government's involvement here? Should they just let these large losses happen? A lot of people argued that with 2008. Why did you bail out AIG and some of these other firms? Why did you work so hard to get Merrill Lynch and make sure he got bought by Bank of America? Well, it's a domino effect, and it's that contagion that, boy, if you let these things go under, Lehman Brothers going under caused a contagion throughout the world that was completely unbelievable to the federal government. And so when AIG started going under and some others, they felt an obligation to step in. But is it better to let these losses occur and let people learn their lesson? Shouldn't we remind people of the foolishness that comes when no price would be, everything's got to work out, you're overly confident. The Fed's decisions to get involved may have squandered a chance to teach that, but I understand when the Fed gets involved. I definitely understand what was going on in 2008. We really don't know what have happened. It's really easy for people to say they should have stayed out, let markets learn their lessons. But if that means 20, 25, 30% unemployment rates, boy, it makes politicians and regulators very, very nervous. Now, just my background with this, the Fed governor, I think it was the Fed governor, Peter Fisher was the one involved in this, and his name comes up in this book. And so we had dealings with BlackRock, and Peter Fisher went and worked for BlackRock. And really all he did for BlackRock is he just went around and did luncheons. So they were just taking him out to be kind of a, show off that they had Peter Fisher. And so they went to Austin. So I drove up to Austin for our lunch with BlackRock. And I'm usually pretty lucky in these type of meetings where I somehow, and maybe I do it, maybe I'm a little evil in this, but I don't think I do. I'm lucky that I get to sit next to the key speaker. And this time I got to sit right next to Peter Fisher. And I did not mention this book to him because he's so badly portrayed in this book. But I did get to hear him talk in detail about long-term capital management and just the stress he was under. And that was his main point is, it's not obvious we should have stepped in. We didn't spend any taxpayer money. We didn't do anything other than tell all these banks it's in your best interest to get this to work out, because the domino effect, and that's what he was worried about as the Fed, is the domino effect. It's going to create something so horrible that we're going to end up spending a lot of taxpayer money. And so I thought that was interesting. It was an interesting meeting because before the lunch, someone mentioned that where my car was parked, that they towed cars away. And I didn't think that was a problem because the sign didn't say that. So I ran over to move my car, and then running over, I tripped over a rock and actually slid on the rocks. And I came back to the lunch, and I had blood all over me. It was incredible how badly I was bleeding. I went into the bathroom and tried to clean up as much as I could. People noticed. In fact, they all saw me fall, which is even more embarrassing. It shows you how much I wanted to talk to Peter Fisher. You think I would have just gotten in my car and left. But I came back. I think I needed a tourniquet. I was bleeding so badly. I tried to wrap myself up as much as I could. I had blood stains all over my suit. It was really pretty terrible. And they all felt sorry for me. And maybe that was the reason I got to sit next to Peter Fisher. But I was not going to give up that opportunity to hear his inside scoop on long-term capital management. So 2001, this is 3 years later. So have we learned our lessons? The authors concluded that the hedge fund industry has been dramatically underestimating the correlation of its returns to the overall stock market and thus remarkably overestimating the value of these funds for investors. 3 years after long-term capital management, and we were doing it all again. Hedge funds as a class have never been more popular or more avidly sold as a panacea for investing ills. 3 years after long-term capital management. So, all this part is saying is finance is not something you can stick into a model with great confidence. It's not quite as it is mathematical, but not as mathematical as we'd like. It's not as exact as we would like, and it's in the inexactitude. That's where the wildness lies in wait. You can see a lot of Taylor in that quote. And as Mark Twain says, history rhymes, it does not repeat. And in my last slide, very frustrating, I remember this is a really incredibly great slide. It's like, who said this? It may be sufficient to note that a big ego is the one quality not recommended for people dealing in financial markets. Traders burdened with too much ego upon taking a loss tend to blame the market for the wrong turning. And I lost the person who said this. I cannot find it anywhere, and I can't find it on the internet. But it's an ironic. If I could tell you the person was, you'd be so amazed that someone would say this who, right after saying this, was caught in a major financial disaster. So sorry, I can't tell you who said that. We don't know. But someone who said that who ended up having their ego destroy them. So that's long-term capital management. That's the last of our cases. What we'll do in the last class, so this is our second to last class. In our last class, we'll spend quite a bit of time preparing for the final exam. I'm going to give you my final thoughts on the class, my final lessons learned, those 5 things at the very, very end of the notes, and then we'll talk about the exam and get you ready for the exam. It is not an easy exam, but it's probably easier since it's open notes. And so we'll get into that the last class.